Hi guys, my name is Jesse and today we're going to talk about passive investing. So let's dive right in. Passive investing is the act of investing your money in a portfolio of broad market index funds or ETFs and leaving it alone for a long period of time. This is the essence of the popular phrase set it and forget it. Now, passive investing is the opposite of active investing, which is actively buying and selling stock, ETFs, or index funds like this guy does. The great thing about passive investing as opposed to active investing is that it's a very simple method of investing that's also highly profitable. And the reason passive investing is highly profitable is because it minimizes the effects of expenses and emotions. As a matter of fact, Warren Buffett says the greatest enemies of the equity investor are expenses and emotions. Now, to find out why that is, let's start by looking at expenses. Expenses directly take away from potential profit. Every dollar of expense you have to pay is a dollar that can't be used to further grow your capital. And what happens is that expenses tend to stack up and end up taking a bigger percentage of your money than is necessary. Seemingly small amounts of money can add up to huge amounts in the long term, so even a very small difference in expense costs should be considered with the greatest care. Now, emotions are the other enemy of investors. As humans, we're liable to make mistakes, and many of them at that. And it turns out that especially when money is involved, humans aren't very good at rationalizing. Our emotions get in the way and inhibit our ability to make good choices. When the threat of big losses or the promise of big returns become involved in the decision-making process, there's an emotional reaction to that potential outcome, and it causes us to act before really considering the rational argument. Now, in investing specifically, what happens is that investors tend to buy at moments of optimism while selling at moments of pessimism. And this graph shows why that's a bad thing. As you can see, we have a tendency to buy at the point of maximum financial risk when we, along with other investors, are feeling optimistic, while selling at the point of maximum opportunity. We become greedy when we should be cautious and fearful when we should be brave, and that is a recipe for disaster. So then how is it that passive investing minimizes the effects of expenses and emotions? Well, notice how I mentioned the word human quite a few times when talking about expenses and emotions. We suffer the negative consequences of these two enemies because we're human. We're emotional beings, we incur unnecessary costs, and therefore we're pretty wasteful investors. By investing passively, we take the human factor out of the equation, and we do this through broad market index funds or ETFs. Now, these investments are perfect because they have low expenses, they can be automated, and they give us an immediate diversification. So when we invest our money in a broad market index fund or ETF, we immediately have a well-diversified portfolio that minimizes expenses, and to top it off, we can take out the human factor by automating our investments. This way, there's no need to do difficult and time-consuming research, which would be the case with active investing. Active investing can often feel a lot like searching for a needle in a haystack, while with passive investing, we focus on buying the whole haystack. By buying the whole haystack and holding it for as long as possible, we earn money as long as the top companies of an economy continue to grow. Now, to use a simple example of how effective a passive strategy is, let's take a look at this graph. This graph represents a $10,000 investment in two index funds, our proverbial haystack. A $10,000 investment in these two index funds in 1972 would have resulted in more than $640,000 in 2014. That's $640,000 for which you had to do next to nothing. The only thing you would have had to do was put $10,000 in a portfolio of two index funds and have patience. It's passive growth. So you see, you could earn a lot of money while you sleep, literally, or do more productive things. I'm not saying that sleep isn't productive, by the way. Now, not only is passive investing really easy, in doing it you're likely to outperform the great majority of investors who invest in individual stocks, and this chart shows that. Multiple studies actually prove that buying and holding a portfolio of broad market index funds or ETFs is the most profitable long-term way of investing for the majority of investors. Where the average investor only earns 2.9% per year, the index investor earns around 7% per year. And the notion that a passive strategy is most suitable to the vast majority of investors is even supported by the best active investor in the world, Warren Buffett, who says, "It's not necessary to do extraordinary things to get extraordinary results. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals." And Mr. Buffett actually backed up this claim in 2008. In that year, he made $1 million bet with a money management firm called Protégé Partners. The bet was that Warren Buffett could pick a passive index fund that would outperform the money management firm for the coming 10 years, with the money management firm selecting stocks they thought would outperform the market. And so that's what happened. Buffett selected the Vanguard 500 Index Fund Admiral Shares, a passive index fund with low costs and high diversification. Protégé Partners selected stocks they predicted would outperform the market. And guess what? With just 2 years on the clock as of today, Buffett is up 65%, whereas the money management firm is stuck at an ample 23%. So you see that when passive investing is done right, it can even beat the professionals. Now, if you want to learn more about passive investing and how you can use it to earn money with relatively little effort, click the link on the screen or in the description below. It'll take you to an article written by my friend and colleague Yadi and should help you figure out how to invest using a passive strategy. If you want to see more videos like this that explain investing concepts to you, you can subscribe to this channel or visit our website. Thanks for watching, guys, and we'll talk soon. Bye!